Hello, Walt here again. So let's say that in this scenario, we're really looking for affordability for the client. And we know that affordability has been very, very difficult for many clients over the last couple of years as home prices have risen so much. Uh, Here, I just wanted to run a scenario for you of what we would show, um, So, in a strategy in which you can employ. Now, these would be in with the original offer. Um, I think it would be important to show something like this to a listing agent. So this will be doubled up in the digital offer. Um, but so in that way they understand the, the strategy which we're looking at employing, and they're understanding really the path of what if the home doesn't appraise. So, excuse me, let's start off with purchase price. Purchase price $500,000. Client would be getting a 6.25% rate. The total payment would be $3,385. That is principal and interest, taxes, insurance, everything, mortgage insurance. Total cash to close would be $65,995. That's 10% down. Now, we want to try to help the client save some money, about $172 a month, either for qualifying reasons or personal reasons for the client. So when the offer is made, it's made at $550,000. We're looking at taking that additional $15,000 and permanently buying down the interest rate to 5.375 in this scenario. So not a full 1%, but 0.875% down. That takes the payment to $3,213, brings the cash to close as well a little bit lower because you've got that $15,000, and that's nice for the buyer. A little less cash to close, and also it's saving them $172 a month. Pretty significant. Now let's just say that the home doesn't appraise. At that point, again, we look at a complete restructure, and let's say that it appraises for $15,000 under the original purchase price, so $485 instead of $500. We then can look at putting 5% down opposed to the 10% down, buying down the rate a little bit, and also buying out mortgage insurance. So that takes the payment to $3,272 in between the two different payments, but it also brings the cash to close in at $64,565, which is was that $1,500 less than $1,500 less than the original purchase price, a little more than the seller buy down strategy if you were able to do that, but it saves the client $113 and gets them below $3,300 a month. So maybe that's for qualifying reasons or whatever it may be. The reason why I share these with you is really strategy becomes very, very important, in which how we structure the overall loan and the strategy to employ whatever it is that the client needs or most wants. In affordability, of course, today there's emotional issues of affordability. There's real reasons for affordability. The client can't qualify for anything higher than maybe $3,300 a month. Maybe it's a payment, maybe it's a down payment, maybe it's cash to close, whatever that may be. We're here to be able to help solve that gap. And that's what I wanted to be able to show you the most here. So I hope that you've enjoyed this. If you have any questions, please reach out. Thanks. Bye-bye.